Three regional banks announced three completely different survival strategies in a single week, and none of them involved competing with the Big Four. Bank of Queensland stopped pretending it is a lender. It is now selling the loans it originates rather than holding them on its own balance sheet, a model that puts it structurally closer to a mortgage broker than a bank. Bendigo and Adelaide Bank announced a deep partnership with major technology platforms, effectively outsourcing its digital infrastructure to companies far outside the banking sector. AMP Bank looked at both moves and signaled it likes what BOQ did. Three institutions, one conclusion. The traditional regional bank model is no longer viable on its own terms. This is not a story about interest rates or credit quality. The Australian Financial Review described it as white flags and Hail Marys. That framing matters. A white flag is an admission that the current position cannot be held. A Hail Mary is a bet that a single improbable play changes everything. What is driving the admission? The pressure is not coming from bad loans. Credit quality across Australian banks remains relatively stable, despite 2 rate hike cycles inside 18 months. The pressure is structural, and it is accelerating. The Big Four plus Macquarie have scale advantages in technology investment that compound every year. AI is reducing the cost of credit assessment, customer service, and compliance monitoring at a pace that smaller institutions cannot match through organic spending. Bendigo and Adelaide's pivot to tech giants is an acknowledgement that the only way to access that infrastructure is to rent it from someone who already built it.
The surface reading is that AI is destroying regional banking. That reading misses where the value is actually going. Bank of Queensland's shift to a non-bank lending model does not make BOQ weaker. It makes BOQ a distribution channel. The loans that originate still exist. The credit risk transfers to whoever funds them. What BOQ retains is the customer relationship and the origination margin. That is not surrender. That is specialization under pressure. The institutions that fund those loans, typically wholesale credit markets and potentially large non-bank lenders, absorb the balance sheet risk in exchange for yield. In a rising rate environment where deposit funding is expensive, that structure can actually be cheaper for borrowers and more capital efficient for the originator. Bendigo's tech partnership story is less about Bendigo winning and more about which technology companies now have a captive distribution network inside Australian retail banking. When a mid-tier bank integrates deeply with a platform's infrastructure, switching costs become prohibitive within 2 to 3 years. The technology partner effectively captures recurring revenue tied to the bank's loan book without taking any credit risk. Magellan Financial Group shareholders this week approved the company's merger with Barrenjoey, another signal that Australian financial services consolidation is compressing the middle layer across every segment, not just banking. The $100 million valuation on AI legal startup Host, which claims to replicate the work of entire in-house corporate legal teams, is running a parallel script. The market is pricing the belief that white-collar professional services, law, compliance, credit assessment, are being unbundled from their institutional homes. The regional banks are not the only ones handing over the keys. The winner swap only holds if 2 conditions stay in place. First, wholesale funding markets remain open and relatively cheap for the non-bank model to function. Second, technology platform partners do not move directly into banking themselves, because the moment a platform decides the distribution relationship is worth less than vertical integration, Bendigo's strategy collapses. On the first condition, the RBA has now raised rates twice in 2 weeks, reversing all of its 2025 cuts. Services inflation has not responded to prior tightening. If the hiking cycle extends to 3 or 4 more moves, wholesale funding costs rise in step, and the economics of BOQ's originate-to-distribute model deteriorate sharply. The non-bank lenders who are currently the backstop buyers of those originated loans are themselves sensitive to funding costs. That chain can snap faster than the individual links suggest. On the second condition, watch whether any of Australia's major technology companies or global platforms apply for an Australian banking license or AFSL expansion in the next 6 months. That is the signal that the current arrangement, tech infrastructure in exchange for distribution, is being renegotiated on the tech side's terms. The weight of evidence points toward further consolidation at the expense of regional bank equity holders, not regional bank customers. But this only holds if the RBA's hiking cycle does not trigger a credit event that forces wholesale markets to reprice non-bank credit risk sharply. If that happens, the non-bank funding chain that underpins BOQ's new model becomes a liability rather than a release valve, and the move that looked like strategic adaptation looks like a cliff instead.
The verification benchmark is simple. Watch BOQ's net interest margin in its next quarterly update. If NIM compresses despite the originate to distribute shift, the model is not working. If NIM holds or expands, the restructure is delivering exactly what management promised.